What is going on, everyone? Happy Wednesday. It is another episode of the Lawron Ballard Show. I am so glad to be with you today. So, I am getting set up here to go live on TikTok. And listen, family, I am behind today. The past 2 weeks have been crazy, but I wanted to make sure that I was still connecting with you all and giving you what I promised to give you, which is value. So today is actually going to be a little bit different format. Normally, I run through the whole thing with the news updates, but actually today is going to be a live YouTube video recording. And so I'm going to go through that teaching. And then once I go through that teaching, I'm going to pull some of the questions that I have been getting from social media and making sure that we answer that on the conversation today. So welcome everyone. Thank you so much for joining me again. And so we are once again talking about all things tax, finances, getting your life together. And at the end of this teaching, I'm also going to jump into something that I posted on TikTok that has done better than I anticipated, for me at least. It didn't go mega viral, but it went viral for me. And so I want to bring that and jump into that today. But let's jump right into the teaching. So tax advice is everywhere. And so in this day and age, you have to ask yourself, the information that I have, is it accurate? Does it work for me? And so in this video, I'm going to share with you the 3 frameworks that I use to evaluate strategies that have literally helped me save clients millions of dollars. And so at the end of this video, I promise you that you will have some frameworks in your toolkit where you can bring them to your tax professional, or you can use them on your own to evaluate the tax tactics and the tax strategies that are in place. So the first framework that I want to talk about is the 3 C's. And let me share with you why these are so important. Because a lot of times, especially when I'm dealing with clients who are of a higher net worth, we're talking about the annual income of 500, 600, a million, $2 million in income. There is certain things that they are comfortable with, certain things that they understand, certain things that they are aligned with, and certain things that they are not. And so one of the things that I did very early in my practice was figure out, how can I best support people based on their preferences? Because as much as you may hear that tax advisory is just a bag of tricks and you can pull out anything, you really have to be specific. And so these 3 C's are the first level of evaluation that I go through with clients. And so the 3 C's are capital, category, and complexity. Capital, category, and complexity. So complexity is very straightforward. How easy or complex is the strategy for my client to understand? I believe it was Warren Buffett says that he does not invest in anything that he cannot comprehend or he cannot understand. And I advise the same thing for clients. If you cannot understand a strategy for tax purposes, it is not for you. Do not use it. The second C is for capital. So depending on the strategy, a lot of people talk about real estate and how you are able to get a significant write-off using real estate. This is true, but there are nuances to that. We've got to make sure that you have the right structuring, that you can take advantage of that. But let's just assume all the variables are in place. If you don't have a property yet, but you're trying to buy a property, you need cash. You need cash, whether it's you invest cash to rehab the property or you need cash to close the deal. You need the capital. Similarly, there are other strategies that you need capital to be able to take advantage of. Donor advised funds are one that you need capital. Real estate, we talked about that. Leasing, equipment leasing, all of these strategies require capital. And so the first thing is complexity. We've got to make sure that we understand the strategy. The second thing is capital. Do we need to make a capital contribution to make the strategy work for us? I had lunch with somebody today who was talking about building custom defined benefit plans, retirement plans. That requires capital, but you can get amazing write-offs, but you've just got to understand that. And then the last one is category. That's the last C. And let me tell you why I think about this. So I use category in two ways. I want to understand if a strategy is a tax mitigation strategy, meaning it's meant to wipe out taxes, or is it a strategy that is going to reduce my tax bill, but also give me a return. Depending on my client, I want one or the other. If I have a client who has a lot of cash flow, they just need an opportunity that's going to lower their tax bill, I'm going with something that's a tax mitigation strategy. So for a real estate investor, that may be something like a cost segregation. That is a tax mitigation strategy only. Now, if I have a client who does not have enough cash flow, then I'm going to look at something that has some type of return. That can be a strategy like oil and gas. So it really just depends on your financial position. But that leads to the question of, well, how do I know what is the right strategy? So you just gave me the 3 C's, but how do I know if this is the right option for me? And so then we move to our next framework, which is really an equation. And it is V equals C plus R. And I know that I recently did a training on this, but we'll just dive into this again. V equals C plus R. And so what is that? That is vision equals coverage plus resources. Vision equals coverage plus resources. Here's what happens with folks though. They have a vision, they have a financial goal that they have set, but they never look at it in the context of the equation. So they have a goal in particular, and they're covering, and when I say covering, I mean life insurance. I'm talking about estate planning. I'm talking about end of life planning. They have their coverage. They have their resources in place. They have savings. They have, they're younger. And so they have working years ahead of them. They have assets, right? But when you look at it in its totality, the vision is not equal to the coverage and the resources that they have. And so that's what happens a lot of times with people, because they don't have a system to measure this for themselves. But when I'm working with clients, one of the things that we're doing is walking through the V equals C plus R equation so that we don't have a stated vision, we have a real vision, because this equation has to balance. I'm an accountant, and so I took my cues from the accounting formula. I cannot have a liability without an offsetting asset. There's got to be balance. It has to tie out. And so similarly in your financial situation, it has to balance. And so if you have a stated vision, but then when you look at your covering, when you look at your resources, and they end up leading you to another value, that means that your stated vision has to change. It's got to change because the equation has to be balanced. So when we're talking about this in the context of tax forward financial planning, what I'm saying is that we have the 3 C's. That's how we evaluate a strategy. That's how we start whittling down our list. Maybe there's 100 strategies that could work for you, but we start going down and taking a look and saying, okay, well, based on my formula, based on my financial picture, based on where I'm trying to go, what type of strategies fit in there? And so if my resources are low, maybe I'm cash strapped, maybe I'm over leveraged, then I'm probably going to look at a strategy that's going to provide some additional cash flow. Or I'm going to look at a strategy that does not require capital. So, cash flow, we talked about oil and gas, but a strategy that doesn't require capital is an accountable plan or the Augusta rule. So, all of these things come into play. We can't just pick a strategy without understanding it in the context of VC equals C plus R. So now that we've talked about the 3 C's, we've talked about VCR, we've narrowed down our list from 100 strategies to 5. How do we pick the right one? The last thing that we consider when we're looking at strategies is opportunity cost. If I invest the cash in this way, or if I make this decision today, what am I missing out on? Going back to our formula, V equals C plus R, it has to balance. And so the Newton's third law of motion tells us that for every action, there is an equal and opposite reaction. And so when we're talking about this idea of opportunity costs, what we're saying is, if I make this decision today, what do I miss out on? Or what gets delayed? Or what do I have to reduce in order for this to make sense? And am I willing to take that risk? Let me give you an example. So when we're talking about opportunity costs, let's say you have 2 opportunities. You need to invest $100,000 in both. One of them, you get a smaller rate of return. So let's say it gives you 5% over 5 years. The other opportunity gives you 10% and it's over 3 years. Depending on what you are looking to accomplish, you may want option number 2. Why? Because I get a higher rate of return and I get my cash back sooner. And so now I need to understand, like, what am I losing out by staying in this opportunity for 2 extra years? That is what we're looking at when we're saying we want to do tax forward financial planning. Because if we just stop at, oh, hey, this sounds good. It's going to lower my tax bill. This is the decision that I want to make. But we have not looked at how does it further elevate me and move me towards my financial goal. I've got a problem. Then if I've missed that, but then if I also don't look at, well, how much am I leaving? What gets left on the table because I made this choice? All of this matters. And this is why I have said previously on this channel that tax planning by itself, as designed, as presented in the marketplace, is incomplete. We need more than what has been provided. Because it doesn't give you the full answer. It doesn't give you the full equation. We need additional information. Tax planning is a part of your wealth management strategy. Tax planning is a part of your financial forecasting. So if you do not understand that, yes, I need to do tax planning, I get that this is an opportunity for me to generate cash flow, then we're already starting from the wrong vantage point. But then layering on to that, I need cash flow, but I also need to understand that how do my tax decisions and my optimizing my tax position, how does that affect me not just in 2026, but in 2036? If we are not having that conversation, then we are missing a major mark. I think I've said this previously, that I was in a training and one of the people in my training asked, well, what happens if we put somebody in a strategy and it reverses? Like, how are we supposed to deal with that? And the presenter basically said, well, tomorrow will worry about itself. From my perspective, and what I want you to understand as someone who is looking for these solutions, that is not a good enough answer. You've got to understand the downside. You've got to understand, how is this going to impact me in the future? And can I position my future self to be able to take on that risk? So I hope that you found this video helpful. I want to just go to one or two questions that I've received over the past couple days. There was a question that came in. To me via YouTube. And so I want to grab that really quick before I sign off. So let's see if we can find this. And there was a question about debt, leveraging debt. Let's see. Let's see. Okay, so this is a question for Root Boy. This came from Root Boy Supreme #1. It says, I have been on the investor side of real estate for some years now, but never got heavy into the tax side of it. But you seem to be versed with taxes. So to avoid paying taxes on 100K earned income, an investor would liquidate that 100K into a property worth 100K, then borrow against the property with a 70 to 80% LTV mortgage. Here's the question. Is the original 100K that was used to purchase that 100K property still taxable, even though it's been recovered back in the form of a loan? So this is the rule that you have to understand when it comes to taxable income. If you have earned it in any way, it is taxable. A loan is not taxable. So it's not like you are getting taxed on 200K transactions. You're only getting taxed on one. Now, where this can be interesting, particularly with real estate, is if you do something called a 1031 exchange. So perhaps that $100,000 came from the sale of a previous property. You could roll those proceeds into a new opportunity, a new property, and then not pay taxes on that first 100,000 and do an LTV on a new property. That is the only way around it. But anytime you earn income, it is taxable. And so we would just need to structure opportunities and strategies around that earned income to make sure that it offsets it. Well, I hope that you found this live helpful. I know that this was shorter and more pointed than what I normally do, but I look forward to getting connected with you all next week. And please, please, please follow me on TikTok, follow me on YouTube, follow me on LinkedIn, Facebook. I'm all over the place. Would love to connect with you. And if you have any questions, you can reach out and I will make sure that we present them here on the show. All right. Have an amazing rest of your week. And until next time, God bless.